It is Tuesday, February 3, 2026, and we are looking at a company that is currently stuck in a very specific, very expensive tug-of-war.
We're talking about Merck & Co.
We are. The stock market is reacting to their Q4 2025 earnings, which dropped this morning, and if you just glance at the headlines, it's confusing.
It is, yeah. Revenue is up. They beat expectations there. But the earnings per share, the actual profit on the bottom line, it looks like a disaster zone.
You really got it.
It looks messy at first glance. We're seeing a classic case of, noisy numbers.
Right.
You have billions of dollars in acquisition charges just clouding the entire picture.
Right.
But if you strip all that away, this report is actually a referendum on one massive question.
The Keytruda question.
The Keytruda question, exactly. Everyone knows Merck is the Keytruda company. It's the best-selling drug in the history of the world. It cures cancer. It prints money.
It really does.
But we all know the patent cliff is coming, that exclusivity is going to run out. So the mission for this deep dive is to figure out, is Merck ready for life after Keytruda?
Or is all this talk about a pipeline transformation just, corporate spin to keep investors from panicking?
That's the one.
To answer that, we have gone through the full stack. The Q4 earnings release, the transcript of the call with CEO Rob Davis and research president Dr. Dean Lai, the slide decks, all of it.
And the press releases.
And I have to say, usually earnings calls are pretty dry, but Dr. Lee was throwing around comparisons to, the invention of ACE inhibitors.
I know.
And talking about drugs that sound like they belong in a Star Trek episode.
He certainly was. There is a lot of confidence coming out of the C-suite. My job today is to verify if that confidence is actually backed by the data or if they are just trying to distract us.
From the fact that they spent $9 billion this quarter.
Exactly.
Okay, so let's start with the elephant in the room, the cash cow. Keytruda, the numbers are just, they're silly.
They're staggering.
In the fourth quarter of 2025 alone, sales were $8.4 billion. That is up 5% year over year. I mean, for a drug this mature to still be growing is impressive.
It is. It's the engine that powers everything else. It's funding all the acquisitions we're going to talk about. But if you look closely at the report, the most interesting Keytruda story isn't the total sales number.
Oh.
It's a tiny line item called Keytruda QLEX.
QLEX. Okay, let's unpack this. This is the subcutaneous version, right?
It's a little one.
So instead of an IV bag, it's a shot under the skin.
Right. And this matters because of friction. Right now, if you are a cancer patient on Keytruda, you are likely going to an infusion center. You sit in a chair, you get hooked up to an IV, you wait for 30, maybe 60 minutes.
A whole ordeal.
It's a burden on your life, and it's a burden on the hospital's resources. QLEX changes that to a simple injection.
But looking at the sales for this quarter,
Yeah.
it's $35 million. I mean, that is a rounding error for Merck. If this is such a game changer for patients, why is nobody buying it?
That is the right question. It looks like a flop, but it's actually a bureaucracy problem. Caroline Litchfield, the CFO, spent some time explaining this. In the U.S. healthcare system, you can't just sell a drug. You need a billing code, specifically a permanent J-code.
Ah, the dreaded J-code.
Without it, doctors, hospitals are terrified to prescribe it because they don't know if or how they will get reimbursed by insurance.
So they're just sitting on it.
They are. Merck expects that permanent code to go live in April 2026.
So the doctors are essentially warehousing the patients, just waiting for the administrative green light.
Exactly. It's a coiled spring. Once that code hits in April, that $35 million number should just skyrocket. It's a reminder that in pharma, innovation doesn't matter if the billing department can't process it.
So true. Now, regarding the cliff, the loss of exclusivity. The market has priced in 2028 as the year the music stops.
That's when the cheap generics flood in.
But CEO Rob Davis threw out a bit of a curveball in the Q&A section.
He did. He suggested the party might go on a little longer. He talked about method of use patents and method of manufacturing patents. And he specifically cited some emerging case law that makes them think they can hold on to exclusivity until May or even November of 2029.
Okay, play the skeptic for me here. Is extending the monopoly by, 6 to 10 months really a strategy? It feels like kicking the can down the road.
Well, you have to understand the scale. We are talking about a drug doing over $30 billion a year.
Right.
An extra 6 months of exclusivity is roughly $15 billion in revenue.
Okay, wow.
That is enough cash to buy another mid-sized biotech company. So yes, it's kicking the can, but when the can is filled with gold, you kick it as far as you can.
That's a fair point. That buys them time to get the rest of the pipeline working. Which brings us to the part of the report that was actually pretty ugly.
Yeah.
The vaccines.
Yeah, this was a rough quarter for the vaccine division.
Gardasil. This is the HPV vaccine. It prevents cervical cancer. Usually this is the reliable steady Eddie. But sales were $1 billion, which is down 35%. That's a massive drop.
It is.
What is going on there?
It's a tale of two countries. First, China. The economic situation there is impacting demand. Plus, there's this anti-corruption campaign in the healthcare sector that is slowing down purchasing.
Okay.
But the bigger hit came from Japan.
What happened in Japan?
So Japan had a catch-up immunization program. Basically, the government said, we missed a bunch of people, let's get everyone vaccinated now.
Right.
That created a massive surge in sales over the last year or two.
Yeah.
But now they've caught up. The program is winding down.
So this isn't a case of people deciding the vaccine doesn't work. It's just they ran out of people to vaccinate in that specific program.
Correct. The market saturation just hit a wall.
Yeah.
However, it wasn't all bad news in vaccines. They have a new player, Capvaxive.
Capvaxive. This is the pneumococcal vaccine, pneumonia shots.
Right. And this is a crowded market. You have Pfizer's Prevnar, which is a juggernaut. But Capvaxive pulled in $279 million in the quarter.
That's a very strong launch.
It is. Litchfield mentioned it's being driven by retail pharmacies.
Yeah.
So people walking into a CVS or Walgreens and getting the shot.
It shows they can still launch a product even if the legacy stuff is stumbling. But let's pivot. Let's talk about the pipeline transformation.
Yes.
Because if Keytruda goes away, something has to replace it. And the company seems to be betting the house on cardiometabolic drugs.
This is the biggest strategic shift we've seen from Merck in a decade. They are moving from being an oncology company to being a heart and lung company. And the flagship for this is Winrevair.
Winrevair. This treats pulmonary arterial hypertension, or PAH.
Yes. And we need to explain what that is because it helps you understand the sales potential. In PAH, the blood vessels in your lungs get thick and stiff.
Okay.
The right side of the heart has to pump insanely hard to push blood through those stiff lungs. And eventually, the right heart just fails.
And historically, we haven't had great ways to treat that, have we?
We've mostly just tried to dilate the vessels a little bit. But Dr. Dean Lai, the head of research, made a comparison that just stopped me in my tracks.
What did he say?
He compared Winrevair to ACE inhibitors.
Unpack that for us. Why is that such a big deal?
Back in the 80s and 90s, ACE inhibitors changed everything for left heart failure. They didn't just treat symptoms. They fundamentally changed the mechanics of the disease and saved millions of lives.
Okay.
Dr. Lees is claiming that Winrevair is doing the same thing for right heart failure. It's not just a medicine. It's a paradigm shift.
And the numbers seem to back up the hype. $467 million in sales this quarter.
Huge.
11,000 prescriptions. But here's where it gets really interesting. They aren't just stopping at PAH. They are looking at something called the Cadence study.
This is critical. The Cadence study is testing Winrevair in a condition called HFpEF heart failure with preserved ejection fraction.
They call that stiff heart, right?
That's the one. And that is a much, much larger group of people than the PAH group.
Magnitudes larger.
If Winrevair works for HFpEF, this isn't a niche drug anymore. It becomes a blockbuster that could rival the big statins. That is the bet they are making.
And connecting this to the strategy, it seems like they are trying to find drugs that serve massive populations, which leads us to the other lung drug they picked up.
Ohtuvayre.
Ohtuvayre.
Yeah, that came from the Verona Pharma acquisition. It's for COPD, chronic obstructive pulmonary disease. Sales were $178 million. It's a maintenance treatment.
So between Winrevair and Ohtuvayre, they are building a fortress in the chest, heart and lungs.
Exactly. They are diversifying the risk. If one mechanism fails, they have another.
Okay, I want to move to what I'm calling the science fiction segment, because there were two things in this report that felt like they shouldn't be possible yet. First, let's talk about cholesterol. We all know the drill. Diet, exercise, statins. If statins fail, you get the injection, the PCSK9 inhibitor.
Right. PCSK9 inhibitors are miracle drugs for lowering LDL, the bad cholesterol. But the problem is human nature. People hate injecting themselves. Compliance is terrible.
Enter enlicitide.
This is the holy grail. It is an oral PCSK9 inhibitor, a pill that does what the injection does.
How significant is that? Because I feel like we always hear about the next big cholesterol drug, but heart disease is still the #1 killer.
It's massive because of friction. There's that word again. If you can give a patient a pill once a day, they will take it. If you tell them to inject themselves, a lot of them just won't.
Right.
The phase 3 results from the Coral Reef trials showed it significantly reduced LDL. But the real signal here is that the FDA granted it a national priority voucher.
Which means the FDA is saying, get this to our desk immediately.
Essentially, yes. The FDA sees the public health crisis of cardiovascular disease. If Merck can deliver a pill that cleans out arteries as well as an injection, that is a multi-billion-dollar asset.
It's a recurring theme here, isn't it? Easier delivery, subcutaneous Keytruda, oral cholesterol. And that brings us to the biggest gamble in the report.
The $9 billion bet. The flu.
They acquired a company called Cidara Therapeutics for just over $9 billion to get their hands on one drug, MK-1406.
Formerly known as CD388.
Now, I hate getting my flu shot. Every year, it's a guessing game. Did the scientists guess the right strain this year? Half the time, I get the shot and get the flu anyway. Merck says this drug fixes that problem.
That's the claim. This is a long-acting antiviral. And the key buzzword here is strain agnostic.
Strain agnostic. Explain how that works biologically. How can you kill a virus if you don't know what strain it is?
Well, think of the flu virus like a person trying to sneak into a club.
Yeah.
Every year, the virus changes its coat, a different color, a different style, to fool the bouncer, which is your immune system.
That's why we need new vaccines every year.
Exactly. We're training the bouncer to look for the new coat. MK-1406 ignores the coat. It targets a part of the virus structure that can't change, like grabbing the person by the collar.
So it targets the fundamental structure of the virus, not its disguise.
Precisely. And because of that, one dose could theoretically protect you for the entire flu season, no matter how the virus mutates.
That is wild. And they are testing this right now.
They are running the Anchor study. And interestingly, they are enrolling heavily in the Southern Hemisphere right now.
Why the Southern Hemisphere?
Because it's summer here, but it's winter there. Flu season is happening in Australia and South America right now. They are chasing the virus around the globe to get the data faster.
A $9 billion acquisition for a flu drug. That seems so steep.
It is, unless you think this replaces the annual flu shot for a lot of people. They think it's a $5 billion plus annual revenue opportunity.
For high-risk people, I imagine.
Exactly. The elderly, the immunocompromised. If you can promise them they are 100% covered for the season with one shot, that is a product worth paying for.
So we have heart, lungs, cholesterol, flu, but we can't ignore the core, cancer. Dr. Lee kept talking about a workhorse, the sac-TMT.
Yes, this is an ADC, an antibody drug conjugate.
For the listener, what is the difference between an ADC and regular chemo?
The best analogy is carpet bombing versus a sniper. Chemotherapy is a carpet bomb. It kills all rapidly dividing cells, which is why your hair falls out and you get sick.
Right.
An ADC is a sniper. It's an antibody that finds the cancer cell, latches onto it, and then releases the poison directly inside. Sac-TMT targets a protein called TROP2.
And why call it a workhorse?
Because they think it works on everything. Lung cancer, breast cancer, endometrial cancer. They have 16 phase 3 studies planned or ongoing.
16.
16. You don't run 16 massive trials unless you are incredibly confident this drug works.
And one more sleeper hit from the pipeline before we talk money. The eye drug, MK-3000.
This one is fascinating for the biology geeks. It's for diabetic macular edema. Dr. Lyon pointed out that we haven't had a new mechanism of action in retinal diseases for 20 years.
We've just been tweaking the same old stuff.
Basically, the current drugs, like Eylea, they work by stopping the leakage of fluid. It's like mopping up a wet floor.
Okay.
MK-3000 is a WNT agonist. Think of the WNT pathway as a repair switch. When you flip it, it tells the blood vessels to tighten up and heal.
So instead of mopping the floor, you're actually fixing the leaky pipe.
Precisely. And in a $15 billion market where 40% of patients don't get better with the current mops, a pipe fixer is a gold mine.
Okay, the science is incredible. But we have to be the adults in the room and look at the checkbook, the guidance for 2026. This is where the rubber meets the road.
And this is where the stock market gets a little jittery. The revenue guidance is $65.5 to $67 billion. That's growth of only 1 to 3%.
That feels stagnant. For a company launching all these sci-fi drugs, why is growth so flat?
It's the headwinds. We mentioned the patent expirations. Januvia and Bridion are facing generic competition. That wipes out about $2.5 billion in sales right there.
Wow.
Plus, the Inflation Reduction Act in the U.S. is forcing them to lower prices on some top drugs. So they are running up an escalator that is going down.
They have to run fast just to stay in the same place.
Exactly.
And the EPS guidance, $5 to $5.15 per share. Last year, it was much higher.
This is simply accounting for the shopping spree. That number includes a $3.65 per share hit from the Cidara acquisition.
So if they hadn't bought the flu company, the EPS would be, what, almost $9?
Exactly. If you strip out the one-time charge, The underlying business is incredibly profitable. They are generating a ton of cash. They are just choosing to reinvest it immediately into the pipeline.
Rather than showing it as profit.
Right, which is what you want them to do if you believe in the long term. You want them buying the future.
If you trust their taste in acquisitions, yes.
True.
Rob Davis finished the call with a very specific, very large number. He said they have line of sight to $70 billion in commercial opportunity by the mid-2030s.
That was his mic drop moment.
But I have to ask, line of sight to the mid-2030s, that is a decade away. A lot can happen in 10 years. Is that a real projection or just a way to keep investors from selling?
It's definitely a bit of crystal ball gazing. Yeah. But think about the pieces we just discussed. If the oral cholesterol pill works, that's $10 billion. If the flu shot works, another $5 billion. If Winrevair hits the big heart failure market,
another $8 billion.
Yeah. When you stack those up, $70 billion isn't actually crazy. It just requires everything to go right.
So putting it all together for the listener, Merck is in a messy, expensive, awkward transition.
They are. They are bleeding from the old wounds, Januvia, Gardasil, but they are aggressively stitching them up with new deals. They are screaming, "We are not just the Keytruda company anymore."
It really feels like a shift in identity.
It is. And here's a thought to leave you with. We spent the last 5 years obsessed with Keytruda, a cancer drug. But look at the new pipeline. A daily pill for cholesterol, a seasonal shot for flu, a maintenance inhaler for COPD.
Those are daily life drugs.
Exactly. Is it possible that the new Merck will actually be more present in the average person's medicine cabinet than the old Merck ever was? We might be watching the transformation of a specialized oncology giant into a massive general health utility.
That is a fascinating shift. Less curing the rare disease, more keeping the world running.
That seems to be the bet.
Well, we will see if the WNT agonists and the strain-agnostic antivirals can actually pull it off. Check the show notes for the spelling of all these impossible drug names.
Because you'll need it.
We'll be back with another deep dive soon.
Thanks for listening.